Hey there, my friend. It is so easy to feel that little knot in your stomach when you think about money, especially when you are in your 20s and just starting out, right? We are all navigating this complex world. And honestly, sometimes it feels like everyone else has it all figured out. But let me tell you, that is simply not true. We are all learning, growing, and figuring things out together. I remember when I was first starting to think about my own finances, it felt like a giant, overwhelming puzzle. All these terms, all these experts telling you what to do. It can really make you feel like you are falling behind. But what I have learned and what I want to share with you is that building wealth, or as I like to think of it, gently nurturing your financial garden, is really about finding peace. It is about building a life where you do not have to constantly worry about every little financial tremor. It is about creating a sense of security, so you can focus on all the wonderful things life has to offer, not just the numbers in your bank account. I saw this study recently from Allianz Insurance Company, and it really struck a chord with me. It said that 67% of Americans fear running out of money more than death. 67%, can you believe that? And 57% they feel anxious when the market drops. Think about that for a moment. More people are more scared of not having enough money than they are of, the big sleep. It is not something we can just brush off, is it? And honestly, these two numbers, they are kind of like two sides. When you do not really know what your financial plan can truly support, how much you can comfortably spend, or what happens when the market takes a dip. Every single little drop can feel like a direct threat to your security, to your whole livelihood. It feels like, oh my goodness, this might be the thing that completely derails my future. And that is where the fear, that icy grip, really sneaks in. It is when it feels like your future, your financial future, is tied to something completely outside of your control, whether it is the market, the economy, or just the latest headlines. So what I want to do in our chat today is something really specific. I want to take these two big fears, this fear of running out of money and this fear of the market taking a nosedive, and gently together, we will figure out how to dial them down. I want to help you, my friend, build a simple, clear framework that puts you back in the driver's seat of your financial life. That feeling of calm control, where you are not just a passenger, but the one holding the steering wheel. So what really helps to quiet this fear? What can we actually do, first and foremost? And this might sound a little obvious, but it is huge, having a written financial plan. Truly, if there is one thing, one single thing, that could immediately start to soothe these fears, it is this. And the data, my friend, is incredibly consistent on this point. Research from big names like Vanguard, Northwestern Mutual, and Charles Schwab. They all show that people who have a written plan are 2 to 3 times more confident. They are also much more likely to stay calm and invested, even when the markets are having a bit of a wobble. But here is the thing, and it is a bit of a head-scratcher. 48% of Americans, almost half, do not have one. So just getting this one thing sorted out, just creating a simple written plan, could make a huge tangible difference to both of those scary statistics we talked about earlier. But, and there is always a but, right? Here is another little snag. Most of us, myself included when I started, do not really know what actually goes into a financial plan because that same Allianz survey, the one we mentioned at the start, it showed that many people do not really know how to plan beyond just, putting money into savings, contributing to a retirement account. Absolutely. That is a fantastic start, truly. But beyond that, you also need a target retirement number, a clear idea of how much you might need, a timeline. You need to think about when you actually hope to retire and how long you imagine that retirement phase might last. And then there is a distribution strategy. This is where it gets interesting. How does all this money you have saved actually transform into income? How does this whole plan truly look in real life? Will it be like a monthly paycheck? Where are your emergency savings tucked away? How are you going to cover any gaps that might pop up? This, my friend, is how you truly turn those savings into a living, breathing plan. It is like giving your money a job description. Allianz also pointed out that most Americans are a bit fuzzy on how Social Security fits into the picture. If you have not done this yet, and please, take my word for it, it is so worth it. Go to the Social Security Administration's official website, SSA.gov, and create your free account. Once you log in, you will be able to see your entire work history, which is pretty cool. You will also see what your projected benefits look like at different ages, from the early bird retirement at 62, all the way to full retirement age, or even 70. And this, my friend, is a game changer, because it helps you decide when it makes the most sense for you to claim those benefits. Because this, Social Security, this is going to be your income floor. It is like the sturdy foundation of your financial house. This is the money that will show up every single month, like clockwork, no matter what the stock market is doing. And that is an incredibly important piece of this whole puzzle because it shows you exactly what your other investments your portfolio actually needs to cover. It helps you realize that your portfolio does not have to bear the entire burden. It does not have to cover 100% of your spending, which can be a huge relief. Allianz also mentioned that a lot of us are not quite sure what taxes will look like in retirement. This is one of the biggest unknowns, and honestly one of the biggest misconceptions out there. Here is the reality, and it might surprise you. Research from the Center for Retirement Research shows that the majority of retirees actually pay no federal income taxes, and we see this really clear trend. About 80% of households pay federal income taxes during their peak working years. That number then drops to about 50% by the age of 65, and by the time they hit 70, it is down to about 35% of households. Why is that? Well, income often tends to decline a bit in retirement. Social Security, for many, is partially tax-free. There are no payroll taxes once you are retired, and many states have more favorable tax rates, where they either eliminate or significantly reduce taxes on retirement account withdrawals. For a lot of retirees, taxes really do fall dramatically once they step into retirement. But remember, my friend, not everyone fits neatly into this pattern. If you have very large traditional account balances, if you are lucky enough to have dual Social Security benefits or a pension, you might not quite fit into this picture. In fact, you might find that you stay in the same tax bracket, or in some cases even move higher over time. So, what is most important, truly, is that you know your own unique situation, that you understand your specific circumstances. Another big blind spot, and this is a tricky one, is knowing what healthcare will actually cost in retirement. This is a huge source of uncertainty for many, and honestly, one of the hardest categories to accurately estimate all on your own. And this, my friend, is exactly why I've partnered with a company called Chapter. Chapter is a Medicare advisory platform. They are fantastic. They help you compare plans across all the major carriers. They help you check if your doctors are covered, if your prescriptions are included, and they truly help you find a plan that actually fits your unique situation. They will help you project what your healthcare costs will truly look like in retirement. This, my friend, is a huge piece of the puzzle. So if you are approaching 65, or if you are already on Medicare and you just want a second opinion, please talk to one of their licensed advisors today. I have a link down below in the description box. It is an affiliate link, as well as a phone number. If you would like to reach out to them, they are a wonderful resource, and truly, they make a big difference. Another way we can really help to combat these fears, both of running out of money and of fearing a market downturn, is by shifting our thinking. It is by thinking in terms of income-based planning versus just portfolio-based thinking. This is a really big one, and it is beautifully supported by research from brilliant minds like David Blanchett and Michael Fink. When retirees, or those of us planning for it, think in terms of, oh, I have a $400,000 portfolio, they often feel a lot of uncertainty with that, because a portfolio itself can feel a bit abstract, a bit like numbers on a screen. It is hard to think of a portfolio in terms of, what will my actual life look like in retirement? What kind of life would that sum of money truly support? But if we gently shift our thinking to thinking in terms of income, specifically guaranteed income, as well as discretionary income, well, then all of a sudden, things start to feel a lot more concrete, a lot more real. Let us just walk through a quick example. Imagine we have a dual income household. One person receives $1,600 a month in Social Security benefits, and the other receives $2,500 a month. That is $4,100 a month in guaranteed income. So, no matter what the market does, my friend, those checks show up every single month, reliable and steady. Now, let us say this household also has $400,000 invested. At a 5% withdrawal rate, that gives you $20,000 per year, or about $1,700 per month. That's $1,700. That becomes your flexible income. This is the part that you can adjust. Maybe you spend a little bit more when the markets are doing really well, and maybe you gently pull back a little bit when the markets are a bit sluggish. Now, just think about how different that feels. In one scenario, you are saying, I have $400,000. What kind of life can I possibly have with that? In the other, you are saying, I have $4,100 a month in guaranteed income, plus about $1,700 a month in flexible income. That, my friend, gives you a real tangible picture that is something you can truly plan around, something you can build your life upon, and it is so easy for us to work with monthly income figures. After all, we have been doing this our entire working lives. We are used to it, and this is exactly what the research shows. When people frame their wealth as income, as opposed to just assets, they experience more stability, more control, and a whole lot more confidence. And more importantly, they feel less anxious, and they feel more comfortable actually spending their hard-earned money, which is what it is all for, right? The next thing you can do, and this is a big one for peace of mind, is to understand safe withdrawal flexibility. One of the biggest fears that sort of looms over the heads of those of us getting ready for retirement is, what if I retire and suddenly the market just tanks? All of a sudden, everything I have worked so hard for, my carefully built retirement plan completely shatters. But my friend, that is simply not how a well-designed retirement plan actually works. Research from powerhouses like Morningstar, Vanguard, and Michael Kitz's, they all show that the 4% rule, which you might have heard of, is a very conservative baseline based on rigid, inflation-adjusted withdrawals. But here is the thing. Real-world retirees, they are not rigid robots, are they? When you introduce even basic flexibility, starting withdrawal rates can actually increase to about 5 to 5.7%, and the long-term success rates of your portfolio improve significantly. And this does not mean dramatic life-altering changes to your lifestyle, not at all. In many situations, it is as simple as gently skipping an inflation raise in your spending or reducing your pull from your portfolio by just 5 to 10% temporarily. Let us go back to our previous retirees, the ones who had that $400,000 portfolio. Let us say you are withdrawing $1,700 a month or $20,400 for the year. Now, imagine you decide to reduce that draw by 10% during a market downturn. So now you are pulling $1,547 per month or $18,564 a year. That is a reduction of about $1,800 per year, which is about $153. If we look at it on its face, it does not even feel like much. And remember that this household would still have those guaranteed income streams, like Social Security, coming in every single month, a steady flow. But when we make small, intelligent adjustments like this, especially in the times where it matters most, research shows us that this can have a truly long-term, outsized impact on the success and longevity of our portfolio. Adjustments like this can improve success rates by 10 to 20 plus percentage points. It can preserve tens of thousands, maybe even $100,000 or more in your portfolio value, and it can extend the life of your portfolio by years. The real benefit, my friend, is not just about the dollar amount of the adjustment. It is about when you make that change, when you reduce your draws, when the market is down, when your assets are a bit depressed. You skillfully avoid selling when it could do the most damage to your portfolio. Instead of locking in losses, you give your portfolio that precious time it needs to recover, to breathe, and to grow back. And more importantly, this gives you a specific, clear plan that you can follow should this situation ever happen when you are retired. And having a plan, my friend, is everything. It means you know exactly what to do, exactly how to react. So, the bottom line is, making these small temporary adjustments can result in a permanent, powerful improvement in your portfolio's health. Number 4, building a cash buffer. This, my friend, is your sequence risk protection. It is one of the most practical, most anxiety-reducing ways to approach retirement, and the idea is incredibly well supported by research. You want to have anywhere from, say, 3 to 5 years worth of cash at the ready, whether that is held in a money market fund, CDs, T-bills,